welcome, along with and thank you for joining myself and Christine. First up question, Jan, Kash, what is the experience of Philippine real estate in terms of the players, in terms of asset repurposing, and what are the challenges and considerations? Jan?
Well, hi, Rick. Well, some have considered the repurposing. Most visible probably would be the car parks. They've been converted into storage facilities. Some have also been converted to garages for repossessed automobiles. And in terms of the mall spaces, some of the retailers have actually set up their space as storage facilities, while most of the transactions have been geared up towards online shopping. So I guess that's one way of them being relevant in this time of the pandemic, since patrons are very limited in terms of visiting the malls and their different store sites.
And to add to what Jan just said, there are also some smaller versions. For example, in retail, initially those were commercial spaces focused on F&B. All of a sudden, it's a healthcare tenant that's coming in rather than it was supposed to be for a retail or an F&B tenant. So we've seen that happen as well. It was mentioned earlier that data centers have strong winds. So yes, these are the industrial locations that are now being considered by data centers and industrial developers or landowners who are keen to service this particular demand that is growing. There are challenges. Some developers have talked to us about converting from hotel or hospitality asset into a residential asset. You know, I think we have some challenges in there in terms of getting licenses to sell, because it's a different ownership structure from a hotel to a residential development in terms of just being straightforward about converting it. So it's still quite tricky. We still haven't found that perfect structure to move it if it's that transition that the asset is that asset will go through.
Well, thanks, Kash, and thanks, Jan. I think definitely some food for thought there. I think so for Jan and Kash, in practical terms, how do you advise the clients who are now looking at asset repurposing, and which asset would make the most sense from a Philippine context?
Okay. First, what Christine presented earlier, that checklist, like really look at that checklist, go through it, and look at which points will be important to you or to you as an investor. And then, because what I want to advise our clients is that this is a global phenomenon, asset repurposing. The case studies presented earlier is a proof of concept that this can work. And generating cash flow at a time like this, it's very important for you to be flexible and adapt to the ever-changing environment. And the things, you know, the assets that make sense, of course, those that are closest and those that are, I would think, wouldn't cost as much to convert into another use. So that, like, I think we've seen the retail into sort of storage, and then that wouldn't cost much to do so. There is, you know, there are opportunity costs involved, but I guess in at this rate, you would already see the demand, where is it going, and you need to catch, you know, to have a slice of that demand, you really have to adapt today. And there's also, I think that the landscape clearly has changed. So even when the market picks up, you'll be prepared, or you would already have a slice of that pie.
Yeah, it's just like any other development that you're going to get into. It will take a lot of patience on the developer side, the ones repurposing the asset. Since that wasn't the intended use when it was first built, there will be some growing pains involved once the repurposing has begun, and once the repurposed asset starts operating. That's why it's like Kash said, and like Christine also presented earlier, You have to tick all of those boxes in their checklist. And once you do, you have to make that commitment in doing so.
Yeah, I think, as you said, I think some people get used to, maybe they were traditionally a hotel and leisure developer, they were an office developer or retail developer, but now they need to pivot and change. So I think they might not have the expertise, but we probably know some people that could help them in project management and you know, the forecast, and look at the supply, demand, and feasibility study or restacking. So I mean, so you don't need to have, you know, perfect knowledge of a certain sector. You know, if you have basic knowledge of one asset class and you can work with advisors, you know, the transition, it's never seamless, but it is a time to pivot, and you see a number of people that have been really successful at and doing that, and also actually building an asset class or switching over to something that's actually far more lucrative and far more interesting. So being able to basically you know, don't worry about the wind, you know, as long as you got wind blowing, just adjust the sails. So huge opportunities ahead. You know, Kash and Jan, I mean, you know, what is your outlook for the property sector in 2022 in the Philippines from an asset class perspective and from an opportunistic perspective?
Well,
Jan, do you want to take that first? Jan, you want to go first?
Dan, you go ahead.
Yeah. Well, there's definitely still going to be some challenges. Like Christine said, hospitality sector still going to be challenged. Also, the retail sector, as long as the quarantine restrictions are in place, very few people will be going out of their homes. Very few visitors, tourists will be coming also to visit. The office sector also will be facing some challenges as well. But I guess everything, we all have to get used to the pandemic being around for the next several years or so. I guess it's just living with COVID. That's what's going to dictate what's going to happen to the real estate sector. The sooner the people can adjust, then the sooner the industry can move forward to recovery.
Thanks, Jan. Kash, your view?
For me, I think I'm also cautiously optimistic for the Philippines. We know that, you know, like this coming Q4, we expect, you know, like consumption to increase because of the Christmas season, and that helps some of the businesses and the economy. And next year is an election year, so there definitely will be, you know, an increase in spending as well. So how that translates to real estate is that we might see some, you know, some transactions in terms of acquisition, disposition, and we might see some strong expansions after the latter part of 2022, but we might see some wait and see attitude earlier in Q1, Q2.
Yeah, thanks, Kash. I mean, yeah, it's, you not only need to study your real estate economics, you need to understand your political science, because it's all a big part of reading the market. So, and, you know, Christine, from an Asia Pacific perspective, I know you talked a little bit about the asset classes, and you know, it is an interesting, you know, tumultuous world. I mean, you know, we've got this new Delta variant that's come in, and you know, we've had multiple waves of this, and in different iterations, but you know, some certain asset classes remain strong. So, from an Asia Pacific perspective, I mean, you know, what sectors do you think basically where you've seen the most opportunity in those sectors, and obviously there's, you know, there's risk versus rewards for the developers that are going out in terms of repurposing and whatnot. So, you know, what's your sage advice for developers that are looking further afield as well?
Yeah, I think the key word is really cautiously optimistic, like what Kash mentioned, because from what we have gathered so far in 2021, the best performing sectors include logistics, residential, as well as office. Office seems to be turning the corner, even for the entire Southeast Asia. which is a laggard in the market. But we are already seeing the slowest pace of decline in Asia, particularly in Southeast Asia, over the last 2 years. So this is a good sign, and we do expect rents to actually bottom out by the second half of next year. So in terms of opportunities, leveraging on the active capital research paper from our global research team, I would say that office continues to be an important asset class for investors to look at in terms of cross-border investments, because this is still the plain vanilla kind of asset investments. You do not need the operational capabilities to be able to buy an office asset and lease it out. But on the other hand, if you do have the operational capabilities, I would think that hospitality sector is poised for greater growth, because by next year, I think a lot of the countries would have vaccinated their population, and there will be probably opening up more for leisure travels. We have already seen in the last 1 month or so, a lot of the countries are actually opening up their borders. So by middle of next year, I'm actually quite positive that leisure travelers will come back, and that is a positive sign, especially for hospitality owners. If they want to tap onto this demand, particularly if they have been, renovating or repositioning some of their assets to a better quality hospitality asset, then this is the time they can actually capture this window of opportunity. But if not, they want to consider other sectors, I would think that office sector would be a good sector to leverage on, or a residential sector, because with this work from home phenomenon, we are seeing pent-up demand in the residential space. A lot of people are actually looking to upgrade to either larger homes, although it can be more expensive on a per square foot basis, but with low interest rates for longer, I think this residential market continues to have the momentum, and it's going to be quite positively correlated to the economic recovery. So with higher GDP growth in 2022, we are likely to see more demand going into this sector.
Thank you, Christine. You mentioned active capital. Let's be frank, this is the hardest hit, the most devastating, the most number of black swans that's come into not just the Southeast Asian market, but the global market. So, and for those of us that are around in 1997, we saw, Asian financial crisis. We saw, it took a while to kick in, but the banks had to restructure. There was NPLs and SPVs and good bank, bad bank scenarios, and great opportunities for investors. And this is when you lock down an economy for a week or a month or a year, let alone a year and a half or longer, you're going to have structural problems. So the difference this time is that there is a world awash with global capital. So for a market like the Philippines, for the office sector, it had been on a boom cycle for 12 years, if not longer. So, and in terms of investors, a lot of the assets went to local investors. Well, I think, as we realized from 1997, the emerging markets, the Philippines, Southeast Asia, they will be obviously reaching out for international debt and international equity. So from your perspective, sitting there in Singapore, how do you see institutional, international, Southeast Asia players looking at the Philippines from an investment perspective?
I think from the Singapore's investors' perspective, Philippines is still a very attractive market, because we know the BPO trend is still going to continue. There is this in terms of the pent-up demand. If you look at the banks, they are giving up space in the expensive markets like Singapore, Hong Kong, and in some of the key markets in China, but they are moving all these mid-office to back-office functions back to the Philippines. So I think there is still good demand for office assets from the Singapore investors' perspective. But of course, I think in terms of the capital, we do see that the developed markets where you have very healthy yield in markets like Australia will continue to attract more capital from Singaporean investors. But I would think that those developers or investors who have previously had exposure in emerging markets in Philippines, I think they will be very interested to pick up some assets, particularly during this window period before the office market recovers. I think it's a good time for them to pick up some of the prime CBD assets. Yeah.
And do you see the Philippines as is it a core? Is it a super core market? Is it an opportunistic, or is it a value add from an institutional investor perspective?
I think institutions from the public market, of course, they would like to have core assets, or the pension funds, insurance, they want to be very risk averse. But on the other hand, if you have the private market, so the private equity guys, they can be a bit more adventurous with their capital because they have different funds which targets at different investors. And that's where I think Philippines can come in between the core and the value add, because a lot of the assets in Philippines are still very modern, less than 20 years old. But on the other hand, there is some opportunity to actually spruce up some of the properties, particularly from the ESG perspective. And then in terms of the leasing demand, I think occupiers are also looking at some of the premium grade asset. And that's where your investors may come in with that value add angle to actually pump in some capital and to see whether they can actually get better returns. Yeah.
Thank you, Christine. Kash and Jan, from your perspective, are you seeing Philippine players, developers, et cetera, end users, et cetera, being more receptive now? I guess Philippine developers being more receptive now to international capital, both equity and debt, than we might have seen pre-COVID. Kash?
Eric, I think, yeah. So most of the developers are now more open into getting outside capital. They understand, the existing situation. I think their first move with the advent of REITs and with it picking up, and that is the first move in terms of gaining capital. While for some, in terms of project-based scenario or perspective, some also need that capital, especially with the ongoing construction, and then there is a slight increase in terms of cost of construction, and having outside capital will definitely help them. From the developers that we've spoken to, they're more open. And I think they also want to sort it out, because as we know, the banks are also getting tighter when it comes to lending, and there's another avenue that they can get capital to help them, buy land, complete their construction, and overall just grow their company.
Yeah, I think, Rick, this has been a trend. Foreign investors have been lining up to come in the Philippines, just waiting for the proper opportunity. I guess this pandemic has opened that opportunity for them. I guess the main hindrance right now would be the ownership restrictions as to how much they can invest in the partnership. So I think in some cases, if exceptions can be made, we can see more foreign capital coming in.
Thank you, Jan. Christine, you mentioned ESG, and I think we've worked with a lot of green buildings, LEED, Platinum, Verde, et cetera. It's really been a nice to have up until now. So now it seems from the survey it appears that it's not a nice to have, it is a must have. So talk us through ESG. Why is it important, and why is it relevant to our Philippine developers and owners on the call?
Thanks. It's a very good question. I think for ESG, pretty much is still at the nascent stage in Asia Pacific, particularly in, I would say, the emerging markets, because typically developers don't pay too much attention to these ratings and certificates. But more and more in the investors' world, I think this is part of the ecosystem. And if you are not ESG compliant, perhaps, 3-4 years down the road, you will see that your pool of buyers is fast shrinking because a lot of this institutional money actually has these ESG requirements when they acquire assets or if they want to deploy capital. So if you are totally ignoring this ESG factor, then you are probably putting yourself in a disadvantaged position because you don't know how resilient is this ESG or is your portfolio against ESG or climate change. I think from the retail investors' perspective as well, I mean, not just real estate investors, but on the whole, if you look at the private wealth, their investors, they are also shunning non-ESG investments. I've been told by some private bankers that some of their clients just refuse to fund any coal mining activities across the world because they are the millennial generation and ESG is really very close to their heart. So when you have a lot of investors that's backing ESG and you are not on that journey, you end up losing that attraction because you are limiting yourself to a group of investors or even your funders to really a narrow band of the whole spectrum. It's pretty much like the iPhone adoption journey. Maybe I just use this example because when Steve Jobs first came up with the smartphone, iPhone 3, I think it wasn't really well received. I think they only sold like 1.2 million sets across the world. But when more and more people start to use iPhone and you realize that you are probably the only one who's still using a Nokia phone with, the number pads, you just feel out of place and you are forced to be converted to a smartphone user. So you don't want to be the late adopters in this journey because by the time you want to trade in your Nokia phone, nobody wants it anymore. So it's better to actually convert early and then to be ahead of the game, just to be on the safe side. But of course, ESG also comes at a price, just that in some markets, we are seeing that the premium is able to cover the long-term operating. The efficiency you generate is actually able to be to offset any additional cost you need for the certificate or the green journey. So it is not too late to embark on this journey. And judging from the capital markets, particularly, when we talk about the REITs evolution, when all of your Philippines developers are looking to institutionalize your assets, this is going to be very essential if you want to be listed and you want to attract foreign capital. So do look out for our active capital research, which has a significant discussion on this ESG journey and the sustainability efforts across the Asia Pacific region.
Clearly, Christine's done a lot of research on that subject, so thank you for that comprehensive and very relevant update. So, final question to the group, which is the office. Much is talked about the death of the office. So I think I think that's probably a long way from the truth, and maybe just we are seeing though is from a Knight Frank perspective. Obviously, Knight Frank does a lot of commercial and residential. So I think to understand the commercial office market now, you have to understand residential because many of our viewers and many of our investors are at home, and so everybody spent some portion of their of the past 24 months on Zoom calls from their home or from someplace else. So return to work, the death of the office, remote working. What's your fearless forecast on the office? Kash?
Great. For me, I think it will be a hybrid model. In a way, it's like we have to learn to live with the pandemic or with the other, variants or whatever that can possibly come. And in the interest, of course, of the level of comfort and safety of the employees, the things that we've experienced so far in our market is that it's going to be some, there's just some jobs that can't be done at home. Sadly, that is the truth. And there was a survey, I think, released that around 50% of the jobs couldn't be done at home, and that statistic is saying that there will be a hybrid model. Some days will be in the office, some days will be at home. It's just a matter of scheduling. It's a matter of efficiently using the space so that there will always be that safety and comfort that can extend even if you go to the office or if you stay home.
Thanks, Kash. Jan?
Well, nothing beats face-to-face collaboration. That's something which is regular with our group before the pandemic. It's easier to throw around ideas, exchange our views, get the work done faster if collaboration is there. You need to make a change in any of your reports. You can do it spot there, right on, because everyone's there. Everyone can readily contribute. And sometimes the eureka moment comes when you're just around a lot of people, just bouncing off ideas. And I think that's also going to be critical moving forward. I agree with Kash, it's going to be a hybrid model. You just can't have everyone in the office all at the same time. But at some point, there will be people have to come back to the office because there's some things that just can't be done effectively when you're doing it at home.
Thank you, Jan. And Christine, final thoughts on back to the office.
Yes, it's a very interesting topic that's close to my heart because last year I was actually heavily involved in a study with the top global banks in Singapore. They are talking about the future of office for the banking sector. And from that study, I really learned a lot from the practitioners. From the sector perspective, I think the big banks are definitely cutting back spaces in the gateway cities because they're expensive. But no doubt, for a market like Philippines, I think they are still very much interested in putting their back-end office in these markets because they are relatively cheaper and it's easy to have all this collaboration, all this setup and infrastructure. Together with this whole pandemic, I think a lot of banks have sunk in this capex in spending, so they would like to make full use of the capex spending, which means they are going to downsize their front offices in gateway cities by quite a fair bit. I think I can give you one example of Stanchart. They have signed an agreement with IWG globally, so in any part of the world, Stanchart employees actually can go into any of the Regis office without any issue because it's considered part of their membership to be these flexible arrangements. And with that, you can see that Stanchart is going to be really working from a whole ecosystem. They have their CBD centers, they have their suburban satellite office where they have a lot of amenities, even including yoga studios and all these work desks. They even have auditoriums, for example. And then on the other hand, they are going to cut back on the desk space. So your desk to table ratio, desk to employee ratio is no longer applicable to such big occupiers. And they, on the other hand, they are looking at the flexibility. So they empower all the members, all the employees with the membership, flexible working arrangements, can be working from anywhere. So this is the model that some of the global banks are looking at. And with that, I think there will be quite a lot of shadow space, secondary space that's coming into the market as a whole in Asia Pacific. But on the other hand, Asia is still the center of growth for the next decade. And we are just starting to see, the emergence of the unicorn, the giants, the tech giants, which have been ramping up their hirings over the last 18 months or so. So these tech giants, including some of the tier one US technology companies, they will be requiring a lot of spaces, and their time frame is so short. They need to hire 20% more headcounts over the next 2 years. So there isn't enough space, even from hybrid working model perspective. They don't have enough physical space to accommodate that kind of growth. Talking about digital banking, talking about fintech, there is still a lot of growth areas and innovation that requires physical space. Like what Jen mentioned, nothing beats face-to-face interaction. So I think this trend is going to continue, and we are still seeing a net increase in the footprint across all these tech giants. So from the sector perspective, it seems like one sector is probably rationalizing, but other sectors are actually stepping up. And from the asset perspective, of course, they are gravitating towards the A grade or A plus grade kind of premium space. So in terms of the vacancy rates, although in many markets we can see vacancy rates in the double digits, but in terms of the A grade vacancy rate is actually not that excessive, which means rent will continue to grow and continue to be elevated for this kind of space. So overall, I think I'm still very positive on office, particularly in the A grade, premium grade sector, because there is demand but not enough supply, because repurposing, redevelopment tends to take a while for the stock to come in, and with construction delays. I think in the next 2-3 years, this is a sector that is very interesting to look out for.
Thank you, Christine. And I'm in full concurrence there. I think we have a lot of people listening to the call, hearing some great perspectives and some refreshing thoughts, and realizing that many people in the same boat. And I think, like most things, people are trying to get over that hump of post-COVID, and when demand comes back, activity comes back, people are back in the office. I'm sure a lot of people in our audience are asking, well, how do they repurpose? How do they reposition? Well, I mean, if you help with those things, clearly Knight Frank and Santos Knight Frank can help, whether it's repurposing your office through project management, whether it's finding new tenants or finding new data centers. In terms of looking for overseas equity or debt, we can help there. I mean, all these things start with evaluation from a capital perspective. So from an ESG perspective, that's highly relevant. We have some experts on ESG, and also understanding the dynamics between office and residential. Nobody knows that better than Knight Frank around the globe. And also, we're very excited about a new partnership with Crescent, which is the #1 tenant representation group globally, which means a lot more deal flow for us. So we're extremely happy about the way things are going. And we also are practical, we're optimistic, and we think there's a way to navigate this market. You have to repurpose, you have to reposition. And this is the greatest opportunity, the greatest threat or the greatest opportunity, but huge opportunities for entrepreneurs who are able to think laterally and think creatively. So thank you, Christine. Thank you, Jan. Thank you, Kash. And to everyone, thank you once again for listening. If you have any questions about repurposing or real estate in general, please don't hesitate to send us a message through the contact details on your screen, or scan the QR code, click on the link, or click the link on the chat box. Many thanks again. Have a great rest of the afternoon. Stay safe, and look forward to seeing you on our next webinar. Thank you.
Thank you.
Maraming salamat.